In July 2025, Congress passed a major new tax law. It is called the One Big Beautiful Bill Act. And starting in 2026, it changes how much you owe and how much you keep. Here's the good news. Average tax refunds are expected to be $300 to $1,000 higher this year. But here's the catch nobody mentions. The law does not send you a letter. It does not automatically fix your paycheck. It does not call your accountant. So two people with the exact same income are going to file this year. One will capture every dollar the new law allows. The other will file the way she always has and quietly leave hundreds of dollars sitting on the table, never even knowing it was there. The only difference between them is knowing what changed. So let me make sure you are the first person, not the second. Let me start with the change that touches almost every single taxpayer. The standard deduction. Quick refresher on what that even is. The standard deduction is the slice of your income the government does not tax at all before you calculate anything else. The bigger it is, the less of your money is taxable. In 2026, that standard deduction rose to $16,100 for single filers, and for married couples filing jointly, it is now $32,200. So right out of the gate, more of your income is shielded before the tax math even begins. The second change is one that matters enormously if you live in a high-tax state. The SALT deduction, that stands for state and local taxes. For years, there was a hard cap. You could only deduct up to $10,000 of your combined state and local taxes. That cap hit a lot of middle-class families hard. Under the new law, that cap jumped to $40,000. If you live somewhere like California, New York, or New Jersey, where state income and property taxes are high, this one change alone could cut your taxable income by thousands. The third change is quieter, but it affects everyone for years to come. The lower tax brackets that were introduced back in 2017 are now permanent. That matters because those rates were scheduled to expire and snap back up. Now they will not. The rates most Americans pay are locked in. Put all three together, and after-tax income for the average household is up about 4% compared to the old law. And I want to be precise about what that is. That is not a rebate you apply for. It is not a check in the mail. It is built directly into the brackets and the deductions, which means you only actually capture it if you file correctly. The money is there. The law put it there. But it does not chase you down. Let me make all of this concrete with two filers. Same job. Same $60,000 salary. Same everything on paper. Call the first one the autopilot filer. She files exactly the way she did last year. Same software. Same boxes checked. Same habits on repeat. She does not check whether the new standard deduction changes her math. She does not look at the SALT cap. She does not think about her withholding. She pays someone $200 to file it the same way it has always been filed and walks away, feeling like she handled it. Now the second filer. Same $60,000, but she does one thing differently. She spends 1 hour reading the plain English IRS summary of what changed. She compares taking the standard deduction against itemizing and chooses whichever gives her the bigger deduction. She checks whether her state and property taxes now clear that higher SALT threshold. She looks at her paycheck withholding to make sure she is not overpaying all year. And she walks away with roughly $800 more on her return. Same income, same forms. Both of them had access to every single one of these changes. The only thing that separated them was 1 hour of attention. That is the entire theme of every tax law ever written. It does not reward the rich or the lucky, it rewards the people who actually read it. And reading it is free. Now I want to challenge the way most people think about a tax refund, because the way you feel about it is usually backwards. A big refund feels like a win. It feels like the government handed you a bonus. It is not. Not really. A refund is your own money, coming back to you late and with zero interest paid to you for the wait. Think about what it actually means. It means you overpaid the government all year long. You gave them an interest-free loan out of every paycheck. And at tax time, they simply return what was always yours. Here's why this matters more in 2026. With the larger standard deduction, a lot of people are now over-withholding without realizing it. They are having too much taken out of every check. If you adjust your W-4 at work, you stop overpaying. And you get that money in every single paycheck, all year. instead of waiting 12 months to get it back. That is money you could be using, saving, or investing the whole time. Now, one more change to know about if you give to charity. There is now a floor for deducting charitable gifts, about 0.5% of your income. So if you earn $60,000, your first $300 in donations is not deductible. Anything above that still counts. It is a small detail, but it changes the strategy. It can make sense to bunch 2 years of giving into 1 year to clear that floor and maximize the deduction. And I want to be crystal clear about all of this. None of these are loopholes. None of it is aggressive or risky. These are simply the rules, as written. They just happen to reward the people who take the time to understand them. So here is exactly what to do with all of this. 4 steps. Step 1. Update your W-4 with your employer. Go to the Free Years Withholding Estimator at iyears.gov. It walks you through your situation and tells you the right amount to withhold. Stop giving an interest-free loan to the government. Get your money in your paychecks where it belongs. Step 2. Run the standard deduction against itemizing. Add up your mortgage interest, your state and property taxes, and your charitable gifts. If that total beats $16,100 single or $32,200 married, you should itemize. If it does not, take the standard deduction. It is simpler and bigger than ever. Step 3. Check the SALT change specifically. If you pay meaningful state income tax or property tax, that higher $40,000 cap might flip you from the standard deduction into itemizing for the first time. It is worth running both numbers. Step 4. Confirm your filing status and dependents are current. The new law also expanded some dependent credits. Make sure your tax software or your preparer has your current household information, a new child, a new marriage, a dependent who aged out. Here is the bottom line. The law did not change for a lucky few. It changed for everyone. Whether you actually benefit comes down to one thing: whether you pay attention. Today, you did. This video is for educational purposes only and is not personalized tax or financial advice. For your specific situation, consult a qualified tax professional. Subscribe. We post every single day. Next, find out why Social Security could run dry by 2032 and the 3-layer backup plan that protects your retirement. See you tomorrow.